Welcome to the Opening Bell Report.
All right, let's get right into it. If you were watching the ticker for IREN recently, your Monday morning coffee was probably ruined.
Huh. That's one way to put it.
I mean, you look at the screen, and it's less of a trading chart and more of a crime scene. We closed at $52.36.
Which is a 7.62% haircut.
Yeah.
In one single
A
session.
huge haircut.
It was an ugly close. There's no doubt about it. And when you see that much red,
Yeah.
you know, the lizard brain just takes over.
It does it.
But our job on this deep dive is to kind of shut that part off.
Yeah.
And actually look at the analysis report from January 27th. Because if you peel back the layers, the data suggests this wasn't really a breakdown. It was a shakeout.
Okay, a shakeout. I hear you, and that's the headline of the report. But
Yeah.
let's be real for a second. Calling a nearly 8% drop that feels a bit charitable when you're the one holding the bag.
Of course.
I watched that intraday chart. It opened at 56.12 and just melted. It wasn't a slow bleed, it was a waterfall. All the way down to 51.78. That doesn't feel like a standard correction to me. That feels like someone knows something I don't.
It absolutely feels that way. That is the psychological trap of a high beta stock like this.
Yeah.
But let's get into the why. You're worried someone knows something, right?
Yeah.
A leak, a scandal.
Something.
But we comb through everything. The report is clear. There was zero negative company-specific news. No press releases, no guidance revisions, nothing.
So what? We're just guilty by association because the broader tech and crypto sectors were having a volatility tantrum. IREN gets punished.
In a way, yes. But it's a little more mechanical than that. You have to look at the setup before the drop. IREN had that massive run-up to $57.05.
It was vertical.
Completely vertical. And when you have a move that aggressive, you create an overbought condition on the daily chart.
You're talking about the RSI, the Relative Strength Index.
Exactly. We were printing RSI numbers that were just screaming hot.
Yeah.
And this sector, when the RSI gets that extended, the trading bots, the algos, they literally stop bidding.
They just snuggled
Bidding.
step away.
They are programmed to pull liquidity when indicators stretch that far. So what you saw wasn't a fundamental panic. It was a liquidity flush. The buyers just stepped aside to let the profit takers, burn themselves out.
Okay, so the buyers went on strike. I get the mechanics of an overbought signal. You can't sprint forever, but usually a cool down is sideways, a drift, maybe a percent or two. This was violent. Does the report justify the severity of that move?
It does, and it points to who's holding the stock right now.
Yeah.
You have a lot of short-term momentum traders who piled in on that run to 57.
The hot money.
The hot money. And when the momentum stalls, even for a second, they don't hold. They just dump. They're capturing their gains and moving on. That makes the downside move faster. But, and this is the crucial part, look at where the selling actually stopped.
$51.78.
That is the number. That is so important. In a free fall, the price is searching for a floor. If this was a real crash, a fundamental break, we would have sliced right through $50 like it wasn't even there.
But we didn't.
We didn't. We hit 51.78, and the volume profile just changed. Instantly.
So you're saying the bleeding stopped because the institutional bid was just sitting there waiting for it?
Precisely. That specific level isn't random. The report highlights that the bulls stepped in aggressively in the low 50s. That tells us that while retail momentum traders were panic selling, the institutional capital saw 51.78 as a discount.
Okay, let's talk about that smart money narrative. I'm always a little skeptical when analysts blame retail panic and then credit the institutions for the save. But there is one data point in this report that is genuinely weird.
The after-hours action.
Yeah.
It's not weird. It's a tell. It's the smoking gun, really.
Okay, so walk us through it. The closing bell rings at 4 p.m. The stock is battered, down almost 8%. Retail traders go home to lick their wounds. And then what?
Immediately after the close, the stock jumps, plus 1.45% to 53.12.
That's what gets me. Why wait? If the big money loved this stock at 52, why not buy it at 3.55 p.m.? Why wait until 4.05 p.m.?
It's about liquidity and psychology. During the trading day, all that panic selling creates noise. It's chaotic.
Right.
Algorithms often prefer the after-hours session to build positions without fighting that intraday momentum. So by waiting until the retail panic died down, they could just sweep the order book.
So they let the frantic sellers drive the price down for them.
They effectively used the retail fear as a liquidity provider to get a better average entry price. Then they scooped it all up when the selling pressure was gone.
It's ruthless.
That is exactly how the market works. It transfers wealth from the impatient to the patient. That after-hours bounce is the market telling you that the closing price of 52.36 was wrong. It was mispriced.
Okay, so the smart money bought the dip after we all panicked. Fine. But we're still looking at a chart that has taken a lot of damage. We're sitting on what the report calls support, but support is just a floor until it breaks, right?
True.
So what's the line in the sand? Where do we actually have to start worrying?
The report identifies $50.50. That is the critical level. Think of that as the invalidation point for the bullish thesis.
50-50.
As long as the price holds above 50-50, the macro bullish trend is still intact.
That's pretty tight, though. We're only a couple of dollars away from that level right now.
It is tight, but that's actually a good thing. It means we're testing a previous resistance level. Remember, we spent so long trying to break above 50.
Right. It was a ceiling for a while.
And now that we're above it, we're coming back down to test it from the top side. It's classic technical analysis.
Right.
Resistance turning into support. If it holds, that confirms $50 is the new floor.
And if it breaks 50-50?
Then we have a different conversation. Then the structure is damaged. But the report argues the probability of it holding is very high, and that's because of the fundamental story.
Okay.
And this is where we really need to shift gears. We can stare at charts all day, but they ultimately reflect the business. And IREN has a bit of an identity crisis right now, doesn't it?
That's putting it mildly. Is it a Bitcoin miner subject to the whims of crypto? Or is it a high-performance computing AI powerhouse? The valuation swing between those two identities is just massive.
And that disconnect is the entire investment thesis. Let's just look at the valuation. At that close of 52.36, IREN is trading at a PE ratio of roughly 30.
Okay, let's stop there. A PE of 30. If this were a utility company, that's expensive. If it were NVIDIA, that's dirt cheap. But for a Bitcoin miner, 30 feels rich.
It does. Most pure play miners trade at much lower multiples. The business is just so capital intensive and volatile.
So is the market saying IREN is overvalued?
If you view them strictly as a miner, yeah, you could argue 30 is a premium, but that is the lazy money view. The report really emphasizes that the smart money is re-rating this stock, not as a miner, but as an AI data center company.
But is that re-rating actually happening, or is that just what the bulls hope will happen? Because looking at the chart, it still seems to move in lockstep with Bitcoin. When crypto dumps, IREN dumps.
The correlation is still there. I won't deny that, but it's slowly decoupling. And here's why that valuation is arguably cheap. The report highlights a $9.7 billion AI cloud opportunity.
A huge number.
We aren't talking about mining rigs anymore. We're talking about high-performance computing capacity. And if you compare IREN to other AI infrastructure plays, a 30x multiple is a bargain.
Right, but opportunity is a buzzword. 9.7 billion is a great number for a pitch deck, but is it translating to real revenue?
It's the total addressable market they are aggressively pivoting into. I mean, think about the infrastructure shortage for AI right now. There's a desperate need for power and for rack space for GPUs.
And IREN has the power?
That is their moat. They have the power infrastructure. The report projects revenue growth of over 300%.
300%.
Vertical growth. Now, ask yourself this. If a company is on a path to triple its revenue by moving into the single hottest sector in the economy, does a 7% drop on a Monday really matter in 3 years?
In 3 years? No, of course not. But it matters to my margin call today. And that's the friction, isn't it? The fundamentals are on this vertical path, like a rocket. But the stock price zigs and zags because the market hasn't fully bought the new identity yet.
And that is the arbitrage.
We're waiting for the market to wake up.
Exactly. You are paid to wait for that realization. The volatility, the zigzag, is just the price of admission for that kind of growth. If the identity shift was already priced in, the stock wouldn't be at 52, it would be at 150. The uncertainty is the opportunity.
I like that framing. The uncertainty is the opportunity. Let's play devil's advocate for a second, though. What if the AI pivot stalls? What if they can't fill that capacity? We are pricing in a lot of perfection here.
And that's the risk.
Right.
It absolutely is. That's why that 50-50 technical level is so important. If the fundamentals were to actually get worse, you would see it in the price action. You'd see it break that support.
But right now, the data points the other way.
Right now, the data suggests the opposite. The fundamentals are getting stronger while the price is pulling back. That's a divergence you usually want to buy.
So assuming we buy the thesis, this is an AI play disguised as a miner, and the drop was just a technical flush. What do? The report's verdict is hold or buy the dip. But, buy the dip is easier said than done.
It is, especially when the knife is falling. But the report is actually very specific, and it breaks it down for two different types of investors.
Okay, let's start with the conservative approach, the I want to sleep at night strategy.
If you're conservative, you don't buy yet. You sit on your hands, you're waiting for confirmation. The report says to wait for a daily close above $54.
54. Why that specific number?
That clears the immediate noise from the drop. If we close above 54, it pretty much confirms the reversal is real, the buyers are back in control, and the shakeout is over.
So you give up about $2 of potential profit.
You do. The difference between, say, 52 and 54. But you are paying that premium for a higher probability of success. You're confirming the trend is back before you place your bet.
Fair enough. You pay for certainty. Okay, so what about the aggressive strategy for the people who saw that waterfall chart and thought, looks tasty?
The aggressive strategy is to bid right into that fear. The report suggests setting buy orders between $51, $50, and $52.
Wow, okay. That is right in the danger zone. You're basically betting that the low of 51.78 was the low.
It is. You are trying to catch the wicks. You know how a chart sometimes dips down for just a few minutes and then snaps right back up?
Yeah.
Those are the wicks. The aggressive strategy is trying to act like the institutional money we were talking about buying when that liquidity flush pushes the price, just for a moment, below its fair value.
It's high risk, high reward. If you catch 51.50 and it rips back to 57, you look like a genius. If it breaks 50.50, you're stopping out with a loss.
Exactly. But look at the risk to reward on that. If you buy at 51.50 with a stop loss just under 50, you're risking about $1.50 per share. Your upside back to the highs is $5, maybe $6.
Okay.
From a pure mathematical standpoint, that is a trade you take every single time.
Right. When you put it in terms of R multiples, it makes sense. You don't have to be right every time. You just need the math on your side.
That's trading. It is not about predicting the future. It's about managing probabilities. And right now, based on this analysis, the probabilities favor the bulls.
So to bring this all back home, we started this talking about that scary number, that 7.62% drop. We felt the panic. But after this deep dive into the report, the picture looks, well, a lot different.
It does. We stripped away the emotion. We saw the drop was driven by technicals, not broken fundamentals. We identified that strong institutional support at 51.78. And we saw the smart money sweeping the floor after hours.
And we reminded ourselves that we're holding a company that's pivoting into a massive AI market, not just a Bitcoin proxy. The thesis hasn't changed, only the price tag.
Correct. The value proposition is arguably even better at 52 than it was at 57.
Before we sign off, I want to leave everyone listening with something to chew on. We talked about how the smart money waited for the after-hours session to buy. They waited for the retail panic to die down. It really makes you question your own reflexes, doesn't it?
It should.
When you are staring at your phone and your thumb is hovering over that sell button because the line is going down, just ask yourself, who is on the other side of my trade? Am I reacting to news the algorithms processed 3 hours ago?
Am I just providing the liquidity to the very institutions I'm trying to beat?
Are you trading the chart or are you trading against the psychology of the herd?
And usually the her is wrong.
Don't be the herd. Thanks for taking this deep dive with us. Check the levels, watch that 50-50 line, and we'll see you on the next one.
Stay rational out there.
Don't forget to like, share, and subscribe for more.